Welcome, everyone, to Habits of a Whole Heart, my podcast on the Humanity Matters series here at hmTv at the Holocaust Memorial Tolerance Center in Glen Cove, New York. And this is part of the much broader series. And I just had as my guest Bernie Fershpan, who is the founder of the entire podcast series. And we are now approaching episode 550. And my particular podcast, this is now episode 48 in 1 year. And I'm very fortunate to have with me my old client and a friend, Jonathan Blau. We met through trademark law.
Yes,
you needed to trademark your brand, and you got to me, and we started talking, and one thing led to the next, and we met up, and it's been great having you as a client. And one of the things that intrigued me when I sat down in your office, I guess about a year ago, was when you wanted to come out with this crazy, wealthy podcast.
Yep.
And I thought that's very interesting, and what a great name. And we were able to secure the name. And tell us a little bit about your podcast.
Sure. So our whole philosophy in terms of how we help investors succeed is not just different than the traditional, conventional, wisdom-based advice that comes from the industry that I grew up in. You know, the wealth management industry, what they call the wirehouses, the Merrill Lynches, and the Goldman Sachses of the world. It's not just different; it's the opposite in many cases. So what crazy wealthy is it's a continuous messaging mechanism for everybody to teach them continually what's needed to succeed as an investor. That's different from what we've all been taught from the time we got out of the womb. So, for example, the industry tries to solve problems for investors that are almost entirely behavioral, with solutions that are almost entirely technical and analytical. It can never work, right? Well, you can't stand the volatility that's been happening the last few years. We'll come out with a low volatility product. We'll put more bonds in your portfolio. That doesn't help the client, because the real threat to the client's wealth is not the temporary movements up and down of the value they see on the statement every month, because they're temporary movements. But it's the permanent disappearance of the value of every dollar that's frozen in a bond that matures in 10 or 20 years. So if I put $1 in today, in 10 or 20 years, it's still $1.
So you're saying people are making decisions based on their emotions, which aren't in their best interest.
It's against every one of their best interests, not in their best
And
interest.
so, one of the things this podcast explores is the way we process information, the way we think, and the relationship between emotions and thought.
Yep.
And how the two interact. And I know this is something that's been an interesting topic for you. So how do we operate and function?
Yeah.
I know we were talking briefly before about both of our strong interest in Dan Kahneman's work.
Yep. He was wonderful. So look, what I like to say, just to keep it in a way that's simple for everyone to understand, the way we behave is programmed into us to have enabled us to survive without thinking. So we were programmed to be able to respond to a bear in the woods or some other animal in the African savannah hundreds of thousands of years ago without thought. So there's an emotional response. And there's the amygdala at the base of our brain, the two walnut-shaped organs, our fear sensors. And the problem is, over the last 50,000 years, the threats have evolved from becoming life and death to, for most of us, financial, right? We have to learn how to navigate the complexities of financial decision-making under uncertainty. And the problem is, since our amygdala, the fear sensors never evolved, it doesn't know the difference today between a bear in the woods or a bear market. The bear market is temporary. It'll go down 20 or 30%. It'll not only recover, it'll go to new highs. That's all of history. But the amygdala doesn't look at that. I mean, I got to protect myself. I got to protect you. I'm going to shoot off the alarm like it was the bear in the woods, and you're going to sell all your investments, and you're going to destroy your plan and maybe never recover from that. So we need to teach people to fight the often narrative-driven emotional responses that we're programmed to have, and replace it by slowing down what I call the amygdala hijack. Right? Get rid of that. Get rid of that quick response. Learn how to take emotional response and turn it into rational, consistent, slow thinking.
So that was an excellent explanation. Of course, Dan Kahneman's book, Thinking Fast and Slow. And so you're moving people from the fast mechanism to the slow mechanism to create that space.
Right.
How do you do it?
So what we do is, first of all, we have to teach them how to unpack all the baggage that they've got in their suitcase. And the baggage is there sometimes because of how we've been programmed, right? We believe that we have to get out of the way of danger because that's how we feel when there's a down market. We feel we have loss aversion bias, right? So we feel the pain of a loss 2.5 times more than we feel the pleasure of an equivalent gain. So because of that, we don't seek out activities in life, whether it's investing or anything else, that have a high probability of maximizing our long-term well-being. We don't. We seek out instead activities that give us the minimum probability of a short-term loss. And oftentimes those solutions are opposite. What we need to survive long-term in investing and otherwise are investments that might be volatile, but that have protected us the best against inflation, real assets. In this case, we use company ownership through stockholders ownership. And then most people, though, want smooth. They want bonds, right? That makes us feel good. It gives it. We know that in the short term, those things can't lose. And so, again, we need the opposite of what our instincts are telling us. So we get them to learn that about themselves, about how we're programmed, why we make the decisions we make, and then they can begin to recognize, wow, I've got to change that. Now, there's a friend of mine named Doug Lennox, who was the advisor to the CEO of American Express and then ultimately Ameriprise, Ken Chenault during 9/11. He got the whole company, Doug Lennox, turned around and directionally in the right place. But what he has is he calls it the 4 R's. So when there's an issue, you want to recognize what? How am I feeling right now? What's my heart beating? Am I sweating? Okay. Then what I want to do is once I recognize, I want to reframe what I'm seeing, and then only after I reframe it, I want to respond. So one of the great examples he gave me is Winnie the Pooh leaves his house and he's wearing a shirt. He doesn't like the shirt. So he's walking. He's like, wow, if I go home now, I'm like halfway to my destination. I got to go home, be late, change my shirt. So instead of changing his shirt, he changed his mind. Shirt's okay, right? That's the process. So rather than reacting right away and running home and being late and all that, he took hold of the situation.
That's great. Right. I love that. So 2.5 times you said we're more averse to...
We feel the pain of a loss 2.5 times more than we feel the pleasure and equivalent gain to be pleasurable. So we're more sensitive to controlling losses than to pursuing gains.
Okay, so now I'm going to digress for a moment and say, why have I been a Mets fan for 64 years and going through the season and how do I communicate this to my son that we should pivot to the Yankees?
So that has, I think, more to do with familiarity bias, right? You're comfortable with the Mets, you know them, you don't want to go to another team, and then they might win and you'll regret that.
Oh, yeah, right. Then
regret aversion, right?
Right, exactly. And I think that comes in with like the slot machines. You have selective reinforcement. Something happens once in a while,
right?
And then it reinforces you on these biases.
Recency bias, right? You're going to look in the roulette wheel. The red came in the last 4 times, so let me bet red, right? That recency bias takes over because what it forces us to do is we look at a recent trend and we extrapolate it into being a future predictable pattern when there is no such thing as future predictable.
And that's why if someone's looking at their stock portfolio and all of a sudden it's down 10%, that's what's most recent.
Yep. And then now they're assuming, all right, it's going to be down another 10, and in 10 months I'm out of business.
So it turns it around. So in terms of these 4 R's and getting people to realize, I would think that what you're doing, and you tell me.
I didn't give you the second R, but it's recognize, reflect, which gives you time to think about it, reframe, and then respond. Right. So the reflect part is the second R.
And what you're doing is you're, in effect, replacing one fear with another fear. And you're saying is that, look, I know you're afraid that the market's going to go down, but you're now making people, by reflecting, thinking, well, the bigger fear isn't the bigger fear is you're going to run out of money, right. Or you're
the only fear,
or you're going to leave much on the table.
That's
that
right.
You could have.
So there's 2 ways I help people with that. I said, listen, there are 2 risks. There's volatility, right? And volatility is a risk in the sense that in the short run, it can cause you to not have access to your funds unless you want to sell them at a loss. If you were invested all in equity, but there's a way to address that risk rationally. And the way we counsel people to address it, only when they're 2 to 3 years away from retirement, we allocate 2 to 3 years worth of spending money. So if someone has $10 million and they're spending $400,000 a year, we'll have, let's say, about $1 million outside of equity. That protects them against what's called sequence of return risk. So if they're retiring in 2007 year end and they're about to see a market decline 60% because of the global credit crisis, they can switch spending after the first normal decline. Normal bear market averages 15% a year, normal down market since 1980. Then we switch the spending to that side pool. And since the average from a peak in the market, the S&P, to a trough and back to new highs historically has been 40 months, as long as you have 3 years living expenses, you're protected against the reality of the threat of the volatility. So it's not, the bond money is not there to do what the industry says to do, which is simply just to protect against volatility for the sake of it. So instead of going down 30%, you might go down 22 during the next. It's there to protect against the timing issue. Very different.
And so you're creating these structures. If I hear correctly, two main things. One, you're reframing for people what it is in their best interests and understanding their long-term best interests, understanding their short-term fears and how we can mitigate against those short-term fears. And you're really being a financial advisor, but more than a financial advisor, and I apologize if this sounds wrong, it sounds like you're like a therapist. You're already like a behavioral.
It's 90% of the battle for every client.
So how did you learn about this and what got you involved with this?
Yeah,
and you've always been this way.
Yeah, well, not always, no. So I'll talk about that. So, but I want to finish some thought and what we just talked about, and then I'll talk about that. So the two threats, the one is volatility, short-term, temporary. It causes concern, doesn't cause damage. The only damage that's caused by volatility is when a temporary loss is converted to a permanent loss through human manufacturing. We sell into it. That's it. We're at new highs today. No one's ever lost money in the S&P 500 because of the S&P 500.
Okay.
So that's the first thing. So there's that temporary threat, not a real threat you should address at all, other than sequence of return risk and retirement positioning. The other threat, which is permanent disappearance, not temporary fluctuation, of the value of every dollar to inflation. And by the industry misdefining the threat as volatility, the solution is more bonds generally. So what they're giving you as the solution is the carrier of what I call the real disease of money, inflation, because it freezes the dollars that you're putting into it, along with whatever that interest rate you're getting for the duration, while inflation is compounding away 3% a year permanently. You never get that back. So don't look to solve a problem that's temporary and put yourself deeper into a problem that's permanent that you'll never get out of. So how did I discover this? So what happened was I joined a firm after I left public accounting with a firm called Arthur Anderson way back when, and I was in the Family Wealth Tax Planning Group. I joined back then in '96 the largest privately owned money management firm called Sanford C. Bernstein and Company.
Oh, yeah. Okay.
And so Bernstein in 2000 merged with Alliance. Now it's Alliance Bernstein. But what I learned at Bernstein, luckily, we talk about Daniel Kahneman, they had a 6-month training program. And at 29, I was the youngest person they'd hired as a direct advisor, as opposed to an assistant to an advisor. And I was very fortunate. Most of my colleagues in the training program were in their 50s and 60s. I was 29. And they were people in their third career because Bernstein invested all the money for every client the same, had the same portfolios. Some had more bonds up, but they had the same stocks. So they wanted people who could distribute the investments. So they were hiring third career stop investment bankers and accountants and people going into the next career because they had the big Rolodex. So in the training program, they had one day, maybe half the day, was maybe 2 hours on behavior. It was very new back then. This was 1996. And they talked about Daniel Kahneman and they talked about behavioral finance. And I just tucked it away. And then what happened was this was 96. So I built the beginning of my career. I brought in about $50 million in client assets that I was entrusted with from 97 when I got out of the training program to 2000, only to watch it from 2000 to 2002 turn into 25 million quickly. And then the same thing happened just 6 years later. I rebuilt the asset base to maybe 80 million. And then the markets went down 60% in 08 and 09. So I watched the 60 turn into about 25 or 30 or something like that. So I found myself talking to same clients during these crises off the same cliff today that I had talked them off a week ago and a month ago. And I said, I'm not helping anybody. It's not working. They're going to call me back. This is going to continue until the crisis ends, which could be a year or two.
Right.
So I discovered that, or I thought that there's got to be a better way to help people succeed with their wealth plans than talking them off cliffs every week. And there's got to be a better way to run a practice that's smoother than having to field calls like that every week and every day from the same people. And that's when it hit me. I said, you've got to do the lifeboat drill long before the bow of the boat touches the water. In other words, if I'm going to disembark people from the Titanic and I start the disembarkment process after we hit the iceberg, I fail. They're panicked. It's over.
Right.
The game's over. If I do the lifeboat drill methodically from the time they decide they're going to consider coming on the Titanic, and then when they come on the Titanic, we do the lifeboat drill again and again, and then we take the trip, I'm going to succeed at getting those people to a disembark. And it's the same thing with our practice. We do the lifeboat drill when at onboarding and the behavioral newsletters and podcasts. So I call it the vitamin C. So if we take vitamin C, if I don't take it every day, it does me no good because it's soluble. Well, it's the same thing. If I help someone behaviorally and then they go back and watch these, I'm not going to say anything pejorative, idiots on CNBC. I said it. But when they go watch these, and you have a person from Merrill Lynch on the right side and a person from Goldman Sachs on the left side, and it's 2025 April, and they say, the question is asked to these both these professionals with big titles, so is this 20% decline now due to the tariffs? Is this going to be the next long-term bear market? Is this a buying opportunity? All right, I'll flip a coin. And so what's interesting, what's been proven is there's a guy named Phil Tetlock who did some seminal work on the efficacy of forecasts. And what he found is that they're accurate 49% of the time. So it's a coin toss.
Wow.
But the worst part of his finding is that he found that the smarter sounding and the better educated forecasters are the ones with the worst forecasting records. Yet we all know they're the ones that you're most likely to listen to when you're watching that unanswerable question on CNBC. And you're going to change your whole plan in response to that forecast.
So one of the things I was thinking of as you were talking about, and I often talk about this, is that you're on the airplane, there's some turbulence, and people get scared. My son used to be very scared of turbulence on an airplane. Yeah. But then you realize like the chance of something happening is very, very remote.
Oh, you also realize turbulence is not indicative of a problem.
Correct.
Right? It's not, doesn't mean the engine's broken. It's the same thing, right? Exactly. Volatility is not indicative there's a problem with your plan or the markets. It's normal. It's part of the ride. So to really prepare,
but once you understand that, like, don't get thrown off by the turbulence. And
100%.
You're saying in stock investing, the turbulence is happening. People are grabbing a parachute and jumping out of the plane.
That's right.
And now they're landing in the middle of somewhere else instead of getting to their destination of where they want to get to.
I love your analogy because I've used it. Even more important. So think about when your son is afraid of turbulence. When the pilot comes on in advance of the turbulence and says, you know, I see we're going to be hitting some rough air, please buckle your seatbelts, versus the plane where the pilot says nothing and you have sudden turbulence hit. Right. Where does your son feel more calm? When the pilot warned you in advance.
Right.
That's the purpose of our newsletters and our podcasts. They're constantly getting the messaging they need to understand the market since 1980 goes down 15% every year. It's called a drawdown, doesn't stay down for any or no reason. And 33%, twice that amount 1 year in 5 or 6, like the crosstown bus. If you can't accept that stoically and stay on plan in the face of it, don't invest in equities. If you can't accept turbulence and not pass out, don't fly.
Right, it'd be like John Madden. You take the Madden-mobile everywhere around the country.
Exactly. You're going to have turbulence every time. You're going to have turbulence every time through your investments in real things that are going to do the best for you. If you can't deal with it, don't invest that way.
Right. And what you're really trying to show someone is that if you really look at it rationally and you look at your long-term interests, there's no reason to be afraid of getting on the airplane and dealing with some of the turbulence you're going to see in the market. But if at the end of the day, that person is so wired where they can't, it's not the right.
Not for them.
It's not the right.
They're not going to make it. They'll never make it. Like that's my job at the beginning is as much as anyone thinks they're interviewing us, we're interviewing them. We want to know if they can have the temperament to get through the way we need them to get through. And why do we need them to get through that way? Because we know when we're living now to 92, a joint life expectancy for a couple, and when inflation for the next 30 years is certainly likely to be much higher than for the last 30, with every major Western government and successful global economic government participant growing their debt much faster than they're growing their economy, that has to show up in the financial markets. and it's going to show up in higher inflation and higher interest rates. And so we need to be prepared for that. So the threats that are always there of inflation and buying too much in bonds and things that don't cure the problem, they're going to be magnified for people over the next 30 years. So it's more critical than ever to understand these things.
Well, to carry the metaphor, due to the climate change, they say that turbulence is getting much more significant.
Right.
So there'll be more significant turbulence, prepared, still safe. You're going to be there, and that's effectively what you're saying. What I find also very interesting, one of the concepts I talk about is resilience and persistence. You had two so-called failures earlier on in your career. You built up to 50 million. First financial crisis took you down 25. You went from 60 million to 30, right? Both times you lost around 50%. Instead of saying, I don't know if you had any doubt, like maybe I should have been a doctor or I should have been a lawyer, and like being a financial advisor isn't for me. You kept with it, and you were open to growing and changing, even though I'm sure many, many others of your colleagues went through that same experience, but you learned something from it. What was it that you think made you wired differently that you wanted to learn from it?
Well, it's just, I think it's just as simple as I was with UBS, I was with not Goldman Sachs, I was with UBS, I was with Morgan Stanley, I was with Citigroup. And at each of the firms, I noticed the same thing, that the analysts, they had a phalanx of analysts and a phalanx of economists. And no matter what they had in terms of the number of resources there, what I learned is nobody, what was his name, Goldman, the movie guy who wrote All the President's Men and Princess Bride, he said nobody knows nothing, because basically said all these producers and directors who are the smartest in the business, they don't know if a movie's going to succeed. They'll tell you what they think. It's the same thing in our business. Like they'll tell you what their forecast is. They'll change it 16 times a quarter, and they know nothing. So I learned that. I'm like, well, this is all not helping anybody. Certainly not helping me as an advisor to rely on what they're telling me to tell the clients. And so I just had to step back. And then I said, how can I help people better than playing what I call the timing and selection game that they play? We're going to tell you what the economy's going to do, and then we're going to use that to time the market for you. We're going to tell you, based on our analysts, which industry is going to do better tomorrow at 3 versus today at 12. We're going to switch you in and out. So since those things can't be done consistently, I said, you know what, this behavioral thing at Bernstein, that makes sense to me. That's what we need to help people with. All this other stuff just makes it worse, right? We counsel people always continuously react to your plan. Stay on your plan. If your plan needed you to have 85% of your money invested in things that will protect you against the biggest threat to it, the inflation, which is equities in this case, or real estate, whatever is real, then have it always. Because stocks for the last 100 years have made 7% a year after inflation. Bonds have made 3% after inflation. So I know at the beginning of my plan, decide I need a lot more of the things that make 7, 2.5 times more than the next choice, which makes 3, if I'm going to make it. And what I tell people who say to me in environments like this, people meaning centers of influence or new prospective clients, is, well, Jonathan, given what's going on with Iran, with the price of oil spiking 20% in 2 days in March, right, what are you recommending? What new decisions, portfolio decisions, are you recommending your clients make in response? And I say to them, my clients don't have any new portfolio decisions to make. We made all our decisions when we decided we needed a lot more 7s than 3s. That doesn't change during a pandemic or a recession or a tariff. I still will need for the next 3 decades of my life and my next generation more 7s than 3s. So all these people changing things in response to current events, they're going to fail.
Right. So you're looking long-term strategy. One of the things that jumped out at me as I'm listening to you is your real motivation is not helping the clients, not helping the clients. I don't even know if you're aware of it, but you're very much focused on what's in the best interest of the clients, as opposed to saying, well, this is going to make me successful.
Yeah, well, you're right. No, you're right. And I teach that to my kids. I never dreamt that one day I would have created a business with the kind of value from a business standpoint that it has today. That wasn't my goal. My goal was to figure out, how do I build a practice that's better for my clients than walking off the same cliff today that I did last week and the week before? And that turned into a very successful business. There's other factors. You get lucky. You're in an industry that rewarded that kind of thing. But, you're right. It's not, I always think in general, one of the articles I just put out on social media is called Something Important That Money Can't Buy. And what it talks about is I'll meet with a new prospective client, I send this message to everyone. If you're going to succeed as an investor, you have to, in your mind, believe that you can have something that your much wealthier friends could never buy. And they look at you and say, well, what is it? What can I have? And it's one word, enough. Because if you don't have enough, it's not about how much money you have. If you're constantly moving the goalpost to the finish line, you're never going to finish. And you're going to run into trouble. And so that's what we teach people, right? And it's the same thing career-wise, right? It wasn't about always wanting more for myself, that we're almost heading toward $2 billion in assets under management. That wasn't my goal. My goal was to do better. When I think of those numbers, like my wife's grandfather he used to say he was a mechanic and he was a gunner in World War II. He used to say, so Jonathan, did you hit $1 billion yet? And back then, I was very far from $1 billion. He died about 15 years ago. He said, even the numbers you're talking about, 300 million, those don't mean nothing to me. I don't understand. And even to me today, $2 billion, it's almost surreal. It's not my money, but having the responsibility to help steward families financially to security at that level. If you think too much about it, you can get a little overwhelmed.
So one of the concepts in my book is to be, I use the athlete metaphor, to be the absolute best athlete you could be and to be the best teammate you could be. When you bring those two together, you're focusing on your personal excellence, on how the best you could do your job, and helping elevate other people. And you're really operating at the juncture of those two. You're a totally focused teammate as a financial advisor to help your clients, their family, their structures, and you're constantly refining your own approach and awareness of how do I best serve. And I know we're almost out of time here, but I want to just pivot because something else that I think is very important here is you also very involved in community, charity. Your abundance that you've been able to create is something that's you're directly helping with, and you're also encouraging your clients to help with. So could you just speak briefly about what that's been like, and then we'll close it out for today.
Sure. Well, it's interesting. In the Jewish community, we have a family that's a client that the son has something called familial dysautonomia, and it's a neurological disorder. Some of the children who have it can look a little bit like maybe they have a little bit of a Down syndrome kind of look, but more importantly, they could be leaning on a hot stove, and if they didn't know the stove's there, they could burn their hand off before they even know it's coming. And it only affects, for whatever reason, it only affects Jewish families. So we've been a big supporter over the years of that, having learned it through our client. And the charity that we're the biggest supporter of, which is really heartwarming when we participate in the events, not just give the money, is called the Sunrise Association. So they have day camps for children with cancer from underprivileged families and their siblings. So the idea behind it, Arnie Herz is the fellow who founded it 20 years ago. The idea behind it was these are underprivileged families, so they can't really afford to give all this care to the child with cancer and still take care of the other children. They just don't have the resources. So now by sending the child with cancer to camp and the siblings, the parents are freed up. And not only that, the kids have a wonderful time. I mean, we volunteer at different days. They have Carnival Day, and the kids give you hugs and kisses. So it's more than, and I'm talking to them now about joining the board, because, it's one thing doing something with your money. It's another thing to get more involved on a time basis.
That's really beautiful, really beautiful. Jonathan, how could people get a hold of you? What's your website, contact?
Sure, thank you. So our website is fusionfamilywealth.com, www.fusionfamilywealth.com. Our podcast is available on the website. There's a section for it, or they can go to crazywealthypodcast.com, and all my contact information and everything else is on our website.
Jonathan, you're a gem. It's been a pleasure knowing you, and I really appreciate you sharing your tremendous wisdom about wealth and caring about others and creating abundance and making an impact in the world and understanding the mind. This has been a really terrific podcast, and I'm hoping to have you again in about 6 months, and we'll evolve to discuss some more topics. So thank you so much for being here, and for everyone, thank you for tuning in to Habits of a Whole Heart here on the Holocaust Memorial Tolerance Center's Humanity Matters series on hmTV. Please tune in. As we shared, we are approaching 1 million viewers a year through the whole podcast series, looking to increase that. Please spread the word. It's on Apple, YouTube, Spotify, all the major outlets. Have a wonderful day, and thank you for tuning in.